In this video, we're going to take a look at an article that went viral on Seeking Alpha just a couple days ago about SCHD. The article titled, "There's Almost Never Any Reason to Own This ETF" by Daniel Jones lays out a handful of arguments against investing in SCHD, even calling it a subpar place to allocate capital. Now, when I first came across this article, I thought it basically looked like clickbait, but the author of this article has over 30,000 followers on this platform, which makes him one of the most followed on Seeking Alpha. According to Daniel's bio, it says that he's an avid and active professional investor. He runs Crude Value Insights, a value-oriented newsletter aimed at analyzing the cash flows and assessing the value of companies in the oil and gas space. So let's take a look and see if there really is almost no good reason to hold SCHD if you're a dividend investor. Now, for the sake of transparency, I personally hold SCHD. I talk about it on a regular basis, and I've always told people the following. Regardless if you're a dividend growth investor or a high-yield income investor, I believe everyone should hold at least one dividend growth ETF in their portfolio. I don't care if it's SCHD or VIG or DGRO or something similar. This will help ensure that your income keeps growing to adjust for inflation, especially if you're an income investor. And these growth ETFs offer dividend growth rates that beat inflation. As is the case with these Seeking Alpha articles, they all start with some summary points. According to the author, I maintain a bearish view on the Schwab US Dividend Equity ETF and believe it will underperform the broader market. The composition of SCHD has changed, with financials and energy stocks becoming a larger portion of this ETF. Alternative ETFs such as the Spider S&P 500 ETF Trust and the Invesco QQQ Trust ETF have outperformed SCHD in terms of total return. So right away, there's a huge red flag I see with the author's first and third main points of this article. Were you able to spot it? According to the article, no one should own SCHD because it likely won't perform as well as the S&P 500 ETF SPY or the Nasdaq 100 ETF QQQ. The author seems to be confusing two completely different investing strategies, which are dividend investing and index fund investing. People who invest in SCHD hold it specifically for its dividend payments first and its share price growth second. People like myself hold this ETF and pursue this style of investing because we like having dividends as another source of income. We like high passive income over trying to capture share price gains from our holdings. Nowhere in this article does the author seem to be aware of this, which is surprising because he writes articles on a lot of dividend stocks. If the author is so concerned about performing as well as the market, why wouldn't he only advocate investing in SPY and QQQ? People who invest in dividend and income investments are more concerned about cash flow first and not share price appreciation. People who do care more about share price growth and not passive income already hold SPY, or they're holding Nvidia before its bubble bursts. So already it's like he's trying to coach baseball players on lacrosse. He's talking to the wrong audience here. Continuing on, the author makes this point about SCHD. The goal here is to invest in large companies that have stable distributions. In the prospectus, even they say that all index-eligible stocks must have sustained at least 10 consecutive years of dividend payments to be included in the aforementioned index. They also must have a minimum float-adjusted market capitalization of $500 million. While this is fine, I believe that this kind of emphasis leaves a lot of money on the table. For someone in retirement, for instance, there are ways of capturing higher yields than the 3.45% that SCHD currently offers. For instance, investing in REITs, MLPs, and BDCs in a diversified manner can achieve yields of 5%, 6%, or even higher. This point towards the end is true, and I'm actually an advocate for this style of investing. If you're retired and want your investments to earn you even higher dividends, then there's a lot of good high-yielding investments that exist. I discuss these investment types all the time on this channel. But as I mentioned earlier, I do believe that dividend investors should hold at least one dividend growth ETF to ensure your income keeps growing well in retirement. REITs, MLPs, and BDCs can offer dividend growth, but it's usually at a much lower rate, which is why I'm still an advocate for holding at least a little SCHD or an equivalent fund. According to most sources, the stock market provides an average annual return of about 8% per year. I've seen some places say 9%, and I've seen 10% in certain instances. If we look at the total return of SCHD over the course of its entire history, we can see it's provided an average annual return of 12.57%. I simply could not imagine telling someone not to invest in something and telling them to sell something with a strategy that's provided these kinds of returns. SCHD has underperformed SPY as of recently, but again, people who like SCHD like to prioritize income. But let's keep going with the article. Other than restating several times about not performing as well as the market, he also brings up how much the fund has changed since his last negative article. He writes, "I would like to note some interesting observations that I made regarding this ETF. There have been some noticeable differences. In particular, financial firms have become a much larger portion of this ETF. The same is true of energy stocks. Over the same time, industrial stocks have become less significant, and the same can be said of information technology firms. This almost certainly has more to do with the performance of different aspects of the market than it does anything else." This was really big news about 3 months ago, so I'm surprised the author wasn't aware of this. As a result of the new sector allocations, it did result in SCHD having a larger yield. But all the author said about this was that it was interesting and didn't really add anything to this point. If we compare the new allocations inside of SCHD compared to what they used to be, you'll notice that there are some sizable differences. Industrials and technology had the biggest hit, followed by healthcare. Both the technology and healthcare sectors aren't exactly well known for paying worthwhile dividends to shareholders, though. Industrials I can understand some concern, because this sector is similar to consumer staples in that there are plenty of companies out there in this field that pay dividends, oftentimes pretty decent amounts. But I'm not complaining about the number of energy companies, though. There's a lot of stocks in this sector that pay really good dividends with typically higher yields. I do think these changes were good for SCHD, and remember, regardless of what's inside this ETF, it still has to abide by its outlined strategy, which is done well. But to wrap things up, no, SCHD is not a holding that dividend investors should sell. It offers the highest yield out of any diversified dividend growth ETF. It has a very low expense ratio. It's less volatile compared to other investments. It has a proven track record of excellent returns. It also has some of the highest dividend growth for any diversified ETF over the long term. People like to pick on this holding because they know it'll drive viewers to their articles, but there's no reason I can possibly think of for completely avoiding this ETF. The arguments made by the author were so weak in this article that his biggest case against SCHD is to completely change your investing strategy to index funds. It's a pretty terrible argument that could be written for literally any single stock or ETF that isn't SPY or QQQ. If you prefer other dividend growth ETFs, then that's completely fine. If you think you don't need a dividend growth ETF in your portfolio, that's also completely fine. And if you prefer index investing over dividend growth investing, again, that's completely fine. But the author doesn't understand why people like SCHD in the first place, which is for dividend income that's consistently grown higher. Let me know your thoughts in the comments, but with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.